In this video, I'm going to show you everything you need to know about trading Forex fast. Forex affects every aspect of your daily life, from buying your morning coffee to refueling your car to going on holidays. This is all made possible through the process of Forex in motion. There is also a free Telegram channel linked down below. Click the link, join the Telegram. We post trading updates and you can be an active member of our community. So what is Forex exactly? The word Forex is a mashup of foreign exchange, and it is commonly used to refer the foreign exchange market, the largest financial market in the world. Picture a massive marketplace trading across all the corners of the globe. But rather than having goods on sale, this market trades in global currencies. The Forex market or foreign exchange market is one of the most widely traded markets in the world, with daily trading volume of over $6 trillion. Unlike the stock market, the Forex market is open 24 hours a day from 5 p.m. Sunday to 5 p.m. Friday Eastern Standard Time. So you might be wondering, where exactly is the Forex market based? Well, it's actually everywhere. Forex is a decentralized market with no single central authority or exchange that governs it. Instead, it is made up of a network of banks, brokers, dealers, and even governments who trade currency with each other. Currency abbreviations. Each currency is represented by a 3-letter code called ISO code. There are some of the main currencies traded. USD is the US dollar, also known simply as the dollar. AUD is the Australian dollar, also known as the Aussie. NZD is the New Zealand dollar, also known as the Kiwi. Euro is the euro. CAD is the Canadian dollar, also known as the CAD. GBP is the British pound, also known as simply the pound. JPY is the Japanese yen, also known simply as the yen. CHF is the Swiss franc, also known as simply the Swiss. What is a currency pair? In Forex, currencies are traded in pairs because when you trade Forex, you are buying one currency while selling another at the same time or simultaneously. Let's look at the pound-dollar currency pair, for example. The first currency in a pair is the base currency, and the second currency is the quote currency. Let's say you get a quote of pound dollar as 1.2655. This means every 1 pound you get 1.2655 of US dollars. There is always an invisible one beside the base currency on the left. So here's what happens when you actually trade currency pairs. When you buy a currency pair like the pound dollar, or when you go long on the pound dollar, you are expecting the pound to appreciate while the dollar depreciates. I hope that is clear. You can rewatch it again if you did not understand. When you sell a currency pair like the pound dollar, or when you go short on the pound dollar, you are expecting the pound to depreciate while the dollar appreciates. Major currency pairs. These are the major currency pairs, which all include the US dollar, as the US is the world's largest economy. Starting out, we recommend sticking to trading major currency pairs as they are the most liquid, meaning you can get in and out of a position easily and fast and with tight bid-ask spreads. What is a pip? In the land of Forex, exchange rates are measured in pips. A pip stands for a percentage in point or a price interest point. This is a standardized measurement for the smallest whole unit price move that an exchange rate can make. In the Australian dollar is sitting at 0.6751, and its value gained by 1 pip, it would move to 0.6752. Most currency pairs are written in 4 decimal places, with the 4th decimal place representing 1 pip. However, some exceptions buck this trend, such as with the yen crossed pairs. The Japanese yen is often quoted to 2 decimal places, so 1 pip gain would be 146.22, rising to 146.23. There is also a pipette, which is a fractional pip. That is 1/10 of a pip, and it is represented by the 5th decimal place. Before I continue, I would want you to tell me in the comments below what video topics I should cover next. As always, please hit the like button as it allows for me and my team to keep producing more free videos on YouTube for you guys. Lot sizes in Forex. Positions are usually measured in lot sizes. A standard lot represents 100,000 units of the base currency. A mini lot is a 10th the size of a standard lot and represents 10,000 units of the base currency. A micro lot is 1,000 units of the base currency, and a nano lot is 100 units of the base currency. Bid, ask, and spread. Each transaction has a bid and ask price. These two prices form the basis for trading on the Forex market. When you are looking to buy an asset on the Forex market, you pay the ask price for the base currency. When you're looking to sell an asset on the Forex market, you will sell at the bid price. The difference between the bid and the ask price is called the spread. I'm very sure you guys have heard me mention about spreads, maybe on TikTok or on other platforms. So the difference between the bid and the ask price is the spread. In essence, the bid ask spread is the difference between the price a dealer will buy currency and what they will sell it for. The spread covers the dealer's profit and the cost of the transaction. It is essentially the cost you pay to enter the market. It's important to note that different brokers can offer different spreads, or they may offer variable spreads that can change based on the market conditions. Brokers and leverages. You as an individual retail trader require a broker to access and trade the Forex market. Brokers provide leverage, which is you using borrowed capital from the broker to trade much larger positions than you otherwise could with the amount of money in your account. Imagine leverage like using a financial lever. With a lever and minimum strength, you can lift heavy loads with less effort. Like a lever that magnifies physical strength, financial leverage magnifies your trading power essentially. Leverage turns up the volume on trades. However, with the potential for more profit comes the potential for more losses. It's important to keep in mind that leverage can act as a double-edged sword. Leverage offerings vary from broker to broker and are usually expressed in a ratio such as 1:50, 1:100, 1:500. Usually, traders will be required to deposit a margin of the trade to act as a collateral for the leverage position. Liquidity. Visualize a vast global marketplace where many players are trading. Each transaction barely makes a ripple on the surface, like dropping a tiny pebble into the ocean. Because of the market's vast size, people can quickly enter in and out of trade without causing much disruption to the exchange rate. Simply put, a liquid market is a financial market where lots of trades occur and it's easy for traders to buy and sell. High volatility means prices are changing rapidly and by significant amounts, like a crazy roller coaster ride with sudden drops and steep climbs. Notice the drastic and wide swing of price, which signals high volatility and means that there is more risk for your trade, but also more reward in times of low volatility. The market is calm with smaller exchange rate fluctuations and price changes. Low market volatility is like leisurely riding on a scenic railway. Notice a small swing of price, which signal low volatility, and that means there is less risk for your trade, but also less reward. Now, there are many factors that can cause the market volatility to increase or decrease. Things like inflation, market demand, foreign policy announcements, political and economic conditions, economic data releases, central bank decisions, natural disasters or crisis, changes in interest rates, stuff like that. With all these factors at play that can cause swing in price. Speculating on exchange rate fluctuations is one of the most common ways for individuals to make money trading in the Forex market. So how do people make sense of the Forex market? Well, traders can employ a range of trading strategies. One, which is technical analysis. With technical analysis, traders can study historical price movements and data in order to identify similar patterns that have the possibility of representing themselves in the future. The idea here is history loves to repeat itself. Think of technical analysis like a detective hunting down clues to uncover how an individual acted in the past in order to try and predict how they will act again in a similar way in the future. Here's a few simple examples for technical analysis in action. You look at a historical price movement. Notice price was making higher highs and higher lows, signaling a moving uptrend. So you believe in the future price will continue to make higher highs and higher lows, so you want to look for long trades to trade with the moving uptrend. And long trade is the same as, buying, like uptrend. When they say long, is buy. When they say short, is sell. Those are the terms that they use in trading. Okay? So to say I've bought gold today, I was long on gold today. If you say I sold gold today, I was short on gold today. You look at the historical price movements and notice every time price came to this area, it reversed drastically, which means this area is of high interest to buyers and sellers. So you believe in the future If price comes back to this area, there's a high percentage chance that price will reverse off of it again, which presents trade opportunities. You look at historical price movement and notice every time price touches this trend line, it bounces off of it. So you believe in the future, if price comes back to this trend line, it will bounce off of it again, which presents trade opportunities. Now, another method people use to trade the Forex market is fundamental analysis. Fundamental analysis examines the broader macroeconomic and geopolitical factors that influences the exchange rate and currency value. Picture fundamental analysis like compiling a weather forecast. As a forecast, you are analyzing the atmospheric conditions to create a prediction for future weather events. Rather than atmospheric conditions, Forex traders are looking at factors like a country's economic indicators such as GDP growth, inflation and unemployment to gauge the health of a country's economy. Interest rate and monetary value policies, events and government policies change, central bank statements, any breaking news and or significant market events. They use this information to try and predict the upcoming market fluctuations in exchange rate and currency value and use them to their advantage. Many traders use an economic calendar as a way to keep track of upcoming events or announcements. Now, this video should give you an overall idea of what Forex is. The next video is going to be how to trade Forex. So I'm going to be showing you how to set up your broker, how to get your logins, how to log into your MT5, your trading platform, and how to execute close trades, how to use it, how to calculate your lot sizes. I'll just cover all of that on the next video. So kindly subscribe, smash that like button, and do not forget to use the link down below to join my free Telegram, as I'll be uploading latest events, news, and very, very important market analysis as well. And I also want to take this time to inform you guys that I have put together a course that is going to take you from complete beginner to a professional Forex trader. All you have to do is click the link down below, join my Telegram. When it launches, I will definitely post it there, and then you guys can join. The first 20 people to get in will get it at just $50. Anybody after that is getting it for 100 and above. See you guys in the next one.